Investment terminology, the old renter lingo. I'm gonna roll through this stuff, and I've done my best to keep this as focused as possible. Make sure I don't put you guys to sleep. This stuff is really important. There's a PDF in here that you can download on the side as well too. So you can a ninja tip here. You get it downloaded. You bring that PDF up, and if you hit Control F on PCs, it can find, and you can find words really fast that way. So let's roll through this. Terminology. Actual cash invested is the amount of capital or cash deployed or invested. And I give an example here of how the actual cash invested is different than the down payment. So if you had this property where you forced equity into it, a value add scenario, what we call air equity, that's actually applied against my down payment. So my actual cash invested decreases. That's awesome. The calculator I'm going to show you here in a little bit, it accounts for that. I love air equity, priming the pump. Absolutely love it. That's one of those times where I get goosebumps when I first learned how not only what it is, how to do it, and how to implement it is really big. Appreciation, increase in the value of an asset over time. Both the fair market value, we call our ARV, and the market rent have the ability to increase or appreciate or decrease. So they can go up and they can go down. History shows that those two numbers do go up substantially. But we don't account for any of that in our equations. I'll show you that. So we don't account for any appreciation on the fair market value or the rents to be conservative. After repair value, ARV, is the estimated fair market value of the property after the repairs have been completed. After repair value, ARV. Capital is the cash or the liquid assets. I think of capital as the money I use to acquire stuff, the money I use to buy houses. Capital expenditures, CapEx. You probably hear this. I mentioned a couple times through these modules. Substantial upgrade, adaptation, or improvement of the property significantly increases the value of the property and often involves structural work and licensed contractors. It cannot be deducted as an expense, as it will be capitalized and depreciated over the longer periods of time. So what this means, and we'll talk about it a little later too in the repair section, it could affect your cash flow. That's the biggest piece. You don't have to be an accountant to know all of this stuff. I am very far from an accountant. I'm not a certified public accountant, but I do keep CapEx in mind when I look at the repairs that we're making because cash flow matters. Capitalization rate. This one I do know, cap rate, is the most popular method of assessing profitability and return on investment potential, assuming the property is purchased cash and not financed. That's the big piece. Cap rate is for cash purchases. What I love about it is it is an apples to apples or oranges to oranges comparison. So even if I've got a property financed, I can look at the cap rate with excluding the finance rate, and then I can compare it to any other investment that I have or any other type of opportunity that I have. So cap rate is big. You'll see cap rate too on commercial investments. Commercial investments is really big, a cap rate. So when we mention cap rate, it's on the cash purchase. Cash flow, boom, love cash flow. Cash or capital received after all reasonable operating expenses and debt services are paid. We also call this mailbox money. The conservative rule, when you are projecting cash flow, you should reduce it by your projected vacancy rate and maintenance rate. And when I say the projected vacancy rate and maintenance rate, you'll hear me say this a lot, adjusted net return, adjusted net income. And in my mind, I've just made this a little easier when it comes down to seeing or expecting what the cash is without having the full accounting breakdown and spreadsheets that are so confusing. We just account for that. And that's called the adjusted net. But most importantly, cash flow is it. And we'll break that down more on the calculators. Comparative Market Analysis, CMA. If you're a real estate agent, you know this one like the back of your hand. It's a process used to evaluate fair market value of a property, and also known as, easy way of thinking about it, the maximum price a buyer is willing to pay for the property and the minimum price a seller is willing to accept. So comparative market value. Comparative market analysis. It's similar. So there's comparative market analysis, fair market value, after repair value. So all of these, the CMA is the process we use to generate the ARV and the fair market value. So all of these terms will here come together. Don't get confused if you just think of it as what the property is worth. We use the CMA to figure out how much a property is worth. Deployed capital. How much money do I have out? The money, cash, or liquid assets spent thoughtfully and effectively. So the cash that I have into a deal is the cash that I have deployed, the capital I have deployed into the deal. Depreciation, let's keep this really simple. This is not an accounting class, but depreciation is a massive benefit of real estate investing. So I want you to have a little bit of idea of, if you already know what it is, that's awesome. If you don't, just take a look. This is a very simple explanation for it. It's basically the reduction in value on the books that we can write off. A basic depreciation method, we'll call the straight line method, is you take the value of the house minus the land property, and you divide that by 27 and a half years. You multiply it by your tax bracket, and that's the actual write-off. That's the actual cash that you keep in your pocket and don't have to pay in taxes every year. You can see an example here as well. Keep it simple. Debt service, the total cash required to pay back all debt obligations, make monthly pity payments, principal, interest, tax, and insurance. Debt service. Most of the time, the debt service is only going to cover the principal and interest because that's what the bank gets and that's what the bank cares about. Taxes and insurance need to be paid in order for the bank to maintain their collateral. So they make sure that that's covered too. Equity, the difference in value and what is owed on the property and the fair market value of the property. And I have a little conservative rule in here. Reduce your projected equity by the cost to liquidate or sell the property. I call this the net equation. Again, if you're a real estate agent, you've probably seen this before, 92.5% or 0.925. If I apply my market value by that, I know that's going to give me my real estate commissions, my closing costs, so that money's gone. And then if I remove the debt I have on the property, then I know that's absolutely my equity. That's my real money equity, not the book's equity. Book's equity is just going to show typically not having those costs of sale in there. Fair market value, FMV, also known as market value in my mind. The maximum price a buyer is willing to pay and the minimum price a seller is willing to accept. Very simple. Gross rental income, any and all payments received in rent, including fees for additional amenities like parking, storage, laundry, etc. One quick note about gross and net. You may have heard this before. Gross is everything. I think of gross as everything. And net is what I actually reel in, right? Gross is everything. Say $1,000 and I may net 200, right? So gross everything. Net is like casting a net and I actually get to bring that home. A little thing I've thought of through the years. Holdback. Holdback is a specified amount of money held back or reserved from the gross income to cover loss in future income due to maintenance and vacancy expenses. What? Basically, it's an amount of money that we set out. We figure 5% vacancy, 5% maintenance. So that 10% comes right out of the gross income. If $1,000, $100 comes out every single month, and we set that aside in an expense account. So that way when a furnace repair has to happen or a smoke alarm, whatever, that money is already in the account. That's where we say the adjusted net income pulls that out of there. So my cash flow is exactly what I'm getting. And I have those holdbacks out of there. Gross rent multiplier, GRM, is a method used to compare rental investment opportunities. We won't get into that, but I put that in there because you're going to hear a lot of investors talk about it. If you want to reference, it's there. Infinite return, we talked about that in the previous module. Being able to pull out more money than what you have invested in the deal. So if I've got 80 in the deal, I get a good appraisal and I can actually borrow 90 on the deal and all my numbers, all my criteria still works, I get to borrow 90. So I get my 80 back and $10,000. The cool part about that $10,000 is, well, there's two things. One, it's tax-free. I'm not an accountant, not a certified public accountant. I don't know any of that. I just know that I don't get taxed when I pull out that extra debt. And the other thing is now, since I have no money in there, my return goes infinite. Very cool. Loan to value, LTV, calculated as the ratio between the loan amount and the fair market value or appraised value. Lenders use this calculation to assess their risk. And that's why you'll see in our investment objectives that we stay at 80% or below the LTV, because that's where we get loan products at. Safe, and you'll see we'll typically stay around 75%. Maintenance rate. This is another holdback similar to the vacancy. We talked about that. We shoot for about 5%. We shoot at 5% when we do the holdback. And that's money taken from the gross, and it's put aside for unknowns. Market rent is the projected amount that somebody would pay to live in your property. Monthly adjusted net income. We talk about this a lot. This is the net income. So after the expenses are paid, we take the holdbacks out of there. And you can see that's, the NOI, the net operating income. And it's the, I'm sorry, I just jumped the line on you. Sorry about that. Monthly adjusted net income. That's just taking out the holdbacks, like I was saying. The net operating income is the amount of income produced by a rental property. This does not include debt service. So NOI does not include debt service. It equals the gross rental income minus the operating expenses. NOI is another one of those terms that you would see a lot in commercial investing. It's a term that gets thrown around a lot between lenders, investors, sellers. So NOI, net operating income. Operating expense, the cost of running and maintaining a property, including insurance, taxes, legal fees, utilities, landscaping, cleaning, repairs, etc. Operating expenses. You still awake? All right, good. Percent ARV. This is really important because we make sure that when we are all in on a property, I don't want to exceed the after repair value. So I want to make sure I'm staying below the after repair value. And I even like to stay so far below the after repair value that even if I sell my property, I won't be out any money for paying realtor commissions or closing costs. PITI, we talked about that briefly. Principal, interest, tax, and insurance. And when you are mortgaging properties and you have a loan, most of the time you get those escrowed so that the tax and insurance will be part of that monthly payment. That's called the PITI payment. If it's not escrowed, then you just have the P payment, principal and interest. Rent ratio, 1% rule. I like this one. This one's a quick study of if a investment opportunity makes sense, and you'll see a little later when we do these quick looks how we use this. So a rent ratio 1% rule measures the price of the rental property, including closing costs and repairs, against the gross monthly income it will generate. Why this is important is I can pull readily available numbers, what it could rent for and how much I would have into it, just real quick to see if I should take this deal and evaluate it. And I have an example there, and typically that 1% is going to be where it's a good pocket to be in. Just as appreciation happens in certain markets, 1% is pretty good. For me personally, I would always look at least 1.2 and higher. And you'll notice when I asked you your self-assessment questions, your tenant class, if you have a property that you can pay a lot less for, you're probably not going to have the greatest tenants, but that rent ratio is going to get much higher. So if you run this rent ratio on a potential deal and you're in like the 2 or 3%, that should trigger a flag in your head and say, okay, what kind of area is this? If you're in the 2, probably like the 1.5 and above, 1.5 up, 1.8 and up, those areas are either one, just a really smoking deal, or the areas is a little rougher. Return on investment, ROI, calculated as the ratio between the value of investment versus the cost of the investment. Value of investment, cost of investment, what? I don't know. ROI is just really simple when it comes down to it. You'll get accustomed seeing to these set numbers. Like I told you, 12%. net adjusted for us is the number that we're looking at on the cap rate. 7 at least on these turnkey deals and above. We're always pushing for 8%, 9% higher. But when you get past it, you start seeing these numbers, the definitions will go away. You'll start feeling those percentages. Rule of 72, I wanted to put it in here. It's a simple equation that would tell you how long it takes to double your money. But a note, it's used for compounding interest and not simple interest. So just something to note. But it's a little helpful if, say, 7%, I would take 72 divided by 7, and that's how many years it would take to double my money at 7% compounding interest, which is like a little over 10 years. So if I put in $100,000 at 7% compounding, and a little over 10 years, I would have $200,000. Rule of 72, cool thing. Total loan amount, easy. That's how much money I borrowed. Total stacked return on investment, absolutely love this. I could go on for hours and hours and hours about stacked returns. It's something that's so special about this asset class and why I feel that everybody should be investing in real estate. The stacked returns happens in real estate when we leverage debt against the property, and it increases our return on investment. So those stacked returns are cash flow. We talked about that. Principal pay down, which is that principal that we're paying that the tenant is paying the bank. Thank you, tenant. Depreciation. So we get to write off the value of the property over the years and reduce our tax liability from that. And appreciation. I don't figure any appreciation in of the property. When we have a $100,000 property, it is say the property is worth $100,000. Most of everybody out there listening to this will be like, where can you buy a property for $100,000? But if you have that $100,000 property, it is likely, history shows that in the next 15 years, the next 20 years, that property is going to increase by 6 figures easy. Along with the rent's going to appreciate too. And if you look at that 15 years, 20-year pocket, it's likely the rent could even double. So there's lots of things happening in the appreciation that we don't account for. Again, we love to underpromise and overdeliver. Absolutely love that. Vacancy rate. Vacancy rate, crickets. That's when nobody's renting your place and you're losing money. We use the vacancy rate to create that vacancy holdback, right? So we'll pull out 5% and hold that back when our maybe we've got a turn and we can't rent it out. We've got to get new paint and new flooring in there or something. That's why I use that holdback. Value add or equity, air equity, forced equity, all of these three things in my mind are considered the same thing. That's when we buy a piece of crap house. We use our proven systems and our killer team to put this together and put back a beautiful home back on the market. That value that we created on paper, we call air equity. Absolutely love it. Again, is another piece or benefit of this asset class that's absolutely remarkable. It allowed me to grow legs as an investor. And I remember, that first year, that first time you look at a financial statement and you see that growth in equity, that growth in net worth. And so much of it comes from air equity. It's amazing. Absolutely love it. So hope you're still awake. Hope that's helpful. Remember, there's a PDF that you can download on this thing, and Control F when you want to look for this as we go through this, depending on your experience as an investor, your experience in real estate. Some of these terms you may not have heard before, but I promise you they're going to pop back up through this process here. So download the PDF, use Control F, find it. We'll talk to you.